Yeah. Okay. So keeping in mind that how useful deferral can be, even given these rate increases, I think it's important to remember that for long-term investors, realizing large capital gains is not something that you're doing every year. So if we say it's like, if you're not going to realize a gain within whatever, 7 years, then you probably don't want to realize it now. Most long-term investors shouldn't be realizing gains, all their gains in such a short period of time. Even someone who's retired living off of their portfolio, maybe they could realize enough gains for the next, 3 years of income or something, or 5 years of income, but not the whole portfolio. Because even retirees are not triggering all of their taxable gains in a single year to fund their retirement consumption. They're triggering bits and pieces, or none if they're living off of just the distributions from the portfolio.
That's a really interesting point, though, Ben. Sorry to interrupt you, because I had this conversation with a client the other day, and they do have a large capital gain inside their corporation, and they are essentially retired, right? So to your point, it might not make sense to rip the Band-Aid off the entire capital gain, but because they are generating, some capital gains every year inside their corporation to fund their retirement lifestyle, do they then take some number, say 3 to 5 years worth of capital gains within, your 7-year break-even threshold, just for the example, trigger them all at once to get ahead of it? It's a bit of a hedge, I guess.
Corporations are different, and we didn't go into that because we'll cover that on a special Money Scope episode that Mark South and I will do. But corporations are different. So when you realize a gain in a corporation, it creates something called capital dividend account, which can be paid out to a shareholder tax-free. And if someone's living off of their corporation, it means that they're taking taxable dividends out. So there's an interesting planning opportunity with corporations where you may want to realize all of your gains to create CDA. I mean, it depends on what the numbers look like, I guess. But that lets you stop taking taxable dividends out of the corporation for some number of years and live off of tax-free capital dividends. So the break-even math on a corporation for someone who is spending dividends out of their corporation is quite a bit different, because you give up on tax deferral on the capital gain, but you can get a lot of that back by gaining tax deferral on not having to take taxable dividends out personally.
Interesting.
So it's quite a bit different. But again, that's a Money Scope topic.
That'll be a popular one.
Yeah.
Popular within the group of 400 people that are interested in this stuff.
I know, but if you're interested, that's the place to go.
Yeah, that's true.
It sure is.
Mark mentioned tax rate risk earlier. I think this really highlights that that's a real thing. We've talked about that on past episodes, that hey, tax rates can change. And a change to the capital gains inclusion rate is kind of a big shock to that. Because, tax, it's just a big one-time jump to taxes on assets. We try to do stuff to mitigate this. I mean, we had Scott Cederberg on a while ago talking about how you can optimize RRSP and TFSA, although he was talking about the American equivalents, contributions based on hedging future tax rate uncertainty. We don't tend to do that because our clients tend to be in a position to max everything out. But we do other stuff, like if someone has a low income year, realizing some capital gains to mop up their low income brackets and increase their adjusted cost base. And that does two things. It reduces tax rate risk, which is what we're potentially seeing now. It also helps to lower the terminal tax bill. So there's a little bit of lifetime tax smoothing by doing stuff like that. And also for people with corporations, again, we'll typically recommend taking some money out of the corporation, at least to fund RRSPs, TFSAs, and RESPs. Again, those are just registered savings accounts with tax preferred treatment in Canada. So I think that idea of tax diversification, I know you're big on this too, Mark, just having money in different buckets with different types of tax treatment, it really does protect you against stuff like what we're seeing right now.
Yeah, you end up with a concentration risk, right? And this is, in reality, many people were organizing their affairs this way for decades, right? Where they were using their corporation as a retirement account. And there's nothing wrong with that. It was, part of the rules. And maybe they were funding some RSPs and TFSAs, but maybe not. And I know clients who had done this where they had used their corporation as their primary retirement savings vehicle. They paid themselves only dividends so that they wouldn't have to pay into the Canadian pension plan. And the corporation has now a massive amount of concentration risk from a tax perspective, right? And to your point, tax diversification by using tax-free savings accounts, paying salary to get Canadian Pension Plan and RSP room, filling up those RSPs, it insulates you from some of these adverse tax changes like the one we're seeing right now. And I have to say, I had an accountant that I work with who I talked with like maybe last year about this. And I was telling him how I'm big on tax diversification. And he was like, no, stuff everything in the holding company. And then the day after the budget, he emailed me. He's like, you were right. Like, I can't believe it, but you were right. And this isn't to say I was right, but this is the exact type of risk we're trying to defend against by using up all these other registered accounts, right? And so there are people, unfortunately, that are going to be disproportionately affected because they didn't take advantage of that in the past.
Yep, exactly. And you can't do it all in 1 year, because to take money out of the corporation, typically you've got to pay personal tax, which means, you know, if you've bled money out of the corporation over time at lower tax rates, great. Now you don't have that concentration risk. But if you decide in this year, I've got $500,000 I want to take out of my corporation, you're going to pay half or more of it in tax.
Yep.
Yeah. And that's another thing, like on the corporate planning stuff, there are even potentially cases where we would recommend taking money out personally, even if there is not registered account room available to invest in a personal taxable account. It doesn't always make sense, but it can make sense in some cases. And again, it gives you that tax diversification. All right. Is that enough on, what do you think, Cameron? We good on capital gains and AMT?
Oh, it was awesome. It's great material.
There's two other, I think, interesting proposals in the budget that are just worth maybe touching on at a high level. So one is the, the lifetime capital gains exemption. So for business owners selling a business, it has to qualify. There's a number of different restrictions to access the lifetime capital gains exemption. But for those that qualify, the first $1.25 million of gross capital gains would, in theory, be exempt if you sell the shares of the business and you qualify for that exemption. The previous limit was, I think, just over $1 million. It was indexed to inflation, and I believe it just crossed $1 million this year. So the new proposal bumps it up to $1,250,000. It will not be indexed in 2025, and then indexing will resume in 2026. So there are cases when those selling a business decide, or depending on the size of the business, may benefit from that extra rate. And then the last one was the entrepreneur's incentive, which is interesting. This is a brand new proposal. It's not a modification of anything else. And what that does is, up and above that lifetime capital gains exemption of $1.25 million, over the next 10 years, they're proposing to phase this in at $200,000 per year until after 10 years, there's a new $2 million exemption limit above the lifetime capital gains exemption. And within that $2 million band, if you sell a business, the capital gains inclusion rate, instead of being 2/3, will be 1/3. So if you sold your business for $3.25 million 10 years from now, and it qualified, the first $1.25 million would be tax exempt. The next $2 million would be subject to a 1/3 inclusion rate instead of 2/3. So there is, some benefit in those cases.
It's a big deal.
But they excluded a ton of sectors from those that are eligible for that benefit. So financial companies, insurance companies, real estate companies, food and accommodation, many service businesses, any professional corporation, none of those benefit. So I think it's largely, like, if you eliminate all that, I think what you're looking at is like a lot of technology companies or small startups and that type of thing that could benefit from it. It's an interesting proposed change, though, that it has some tax planning implications as well.
Mm-hmm.